Insurance organisations need to develop new ways of pricing if they want to remain competitive in today's market. But whilst data enables insurers to make the most informed price decisions,
governing and processing this data across siloed database and platform remains a stiff challenge, as is the need to adapt to new rules and regulations such as the FCA review into GI pricing practices, as well as employing and nurturing the right skills to succeed. With this in mind, I'd like to welcome you to this live interactive webinar, The Future of Pricing, How Can Insurers Use Data and Technology to Remain Competitive, brought to you by Insurance Post in association with WNS, where an expert panel will explore how leveraging data and technology can generate actionable insights for pricing. Now, I mentioned my expert panel. I'd like to welcome to you now. We have Garima Gupta from WNS Global Services, Ian Hilder from Dual Group, Tim Pitt from QB Insurance, and Annarita Roscino from Zurich. Welcome, everybody. Now, I also mentioned this is an interactive webinar, which means you can take part in two ways. At any point during the broadcast, you can use a tab on your screen to ask the panelists a question. We also have some poll questions for you to answer, and we'll push the first one of those live now. And that first poll question is, what stage is your organization's pricing process in? And there are three responses. Using GLM models, started using external data and machine learning techniques, and finally, using new age techniques and models is on our roadmap for this year next. So if you can get answering those poll questions, we'll come to those later on in the broadcast. So for my first question, I'll come to you first of all, Tim. And can I just ask, how can you marry traditional actuarial pricing, machine learning and advanced analytics capabilities to change the way a firm creates their pricing model?
Hi, Jonathan. Thanks for having me on the webinar. So at QBE, we use both approaches, really. And so typically it depends on the volume of data that we have. And so we would use more advanced machine learning approaches if we've got more data, less data, so more traditional approaches. And typically for machine learning, we tend to use that for what I call feature selection. So that's where there's a lot of different sort of variables that could be used for the pricing. We use machine learning to kind of sift through all those variables, figure out which ones are predictive, which ones we want to use in our pricing. And then we will use the sort of more traditional techniques, whether that's GLMs or one-way analysis, to actually calibrate the model. So we're using that kind of hybrid approach, typically machine learning to sift through, kind of lots of data, figure out what is meaningful, and then a more traditional technique to actually form the pricing model that we use.
Ian.
Yeah, we are probably some way behind, I guess, in terms of move towards use of advanced analytics, and Tim described. I mean, we're very much at the moment in the traditional camp. I do see the route out of this and the route forward as very much along the same lines as Tim. Well, I mean, the first key is obviously data and actually collecting the data and having the data in a usable format. But the additional capabilities that advanced analytics can offer you is to help you to first of all identify what sorts of relationships might be relevant in the pricing. But I think the first stage then will probably be to revert back to more traditional approaches we would use to then quantify the rating factors that we would use. And only once we've got something with those sorts of approaches, we'll probably go into more sophisticated analysis. But at the moment, it's very much, for us at Dual, the effort is principally focused on getting the data into a usable format, a format of consistency and in the volume that we need in order to support traditional approaches.
Garima.
Yep, I would want to take a step back and really explore why are we really talking about data and technology for insurance pricing team. I mean, as far as I know, data has always been part of the pricing decisions an insurance company takes. But what has really changed is in the last few years, with the coming of technology, data has become much bigger. We call it big data, and hence, while the fundamentals of analyzing data has not changed, fundamentals of pricing models have not changed. But our approach to collating and understanding data, creating accessible and useful information, and the skill set required to really use it has almost entered a new paradigm. And in my last few years of working with insurance companies globally and their pricing departments, I've seen that the pricing department of forward-looking insurance companies are able to bring a very good blend of old and new school very beautifully. For example, like Tim was mentioning, machine learning techniques are able to predict the loss costs or pure premiums more accurately than the general linear models, what we call GLMs. Making pricing more accurate helps at optimizing premiums and managing risk decision. So it's essentially, if you're able to adopt and bring the beauty of both together, your ability to forecast prices better, forecast loss costs better becomes, definitely improved. So, I would say, it is very, very important to bring both the two together. And I'm seeing a lot of companies doing that today.
Annarita.
I'm going to echo actually what most people just said, that Zurich has been, for the past few years, has been all about the blend. Has been about the blend of traditional and new techniques, both from a toolkit / techniques point of view, but also from a skill set point of view as well. So as we were developing more and more data science capabilities, the balance kind of like changed and shifted from more traditional towards, more advanced techniques. I would say, if I look at our journey in the last 5 years, it's really been about, starting with the GLM as a base and then starting adding external data, starting creating external data using machine learning techniques or advanced analytics techniques, and then now starting building models that can predict claims using machine learning techniques. So has been really like a journey. And with these things, and especially with pricing, I've never been an advocate of a big bang solutions. I've always thought that it's good to move gradually from one place to another, because that allows us to make sure that we observe the results and we are absolutely clear about what is happening in the market with our decision, but also builds the capability in-house so that we are then able to really support and bring these solutions to life with a strong skill set that we have built throughout the years. So yeah, the blend, definitely, the building of the skills and, the gradual approach, I would say, is what we have been adopting at Zurich.
And I mean, Annarita, there, you mentioned the word journey. Based on where you are in the machine learning adoption journey, how do you juggle the traditional with the new, Annarita?
It's exactly as we said, it's a journey. So we would always look at the use cases and where we apply things. So if we're looking more of a retail space, so where clearly the price needs to be updated more regularly, etc., then we would use more machine learning techniques either to understand what our pricing are currently doing, so actually from an impact point of view, as well as then from a pricing creation point of view. When you look more of a commercial business and the pricing that sits in that area that perhaps doesn't need the same level of refreshing, then the balance is slightly different. There's still more reliance on GLM and traditional techniques, but the external data and the ability to create new insights with external data is where really we are using more and more machine learning. So it's really, the journey is also about the outcomes, and it's also really changes on the basis of the markets. But in general, we have been very, very flexible and very open to trying new things, keeping always an eye on what the results are like.
Garima.
Yeah, I would just say, having worked with so many insurance companies in the last few years, I feel, whether an insurance company is in the early stages, infancy stages, or in the advanced stages, one thing which we cannot deny is that everyone appreciates the benefit that the new advanced analytics techniques, machine learning techniques, models bring into table. And that's why when I work with, the key pricing heads of various insurance company, I really tell them to test the waters to some proof of concepts and pilots first. They can use machine learning in tandem with the GLMs and understand how it is performing to the actual data and estimate the impact and benefits to make a final decision. instead of hurrying into the journey. Generally the kind of impact analysis which companies do post deploying, say, advanced analytics or machine learning models proves the point. These models have much better predictability and accuracy levels. And hence, we don't need to prove anything in the end. When we bring the beauty of both, the results are much better than the traditional techniques. And that works out, seamlessly.
Tim.
Yeah, I mean, my comments would be similar to Annarita's, actually. So it typically is determined by the volume of data that we've got. So if we've got more data, we're more likely to use machine learning approaches rather than traditional approaches. And then picking up on another point, it tends to be where we've got external data. That's where we tend to use machine learning most to sift through that. So yeah, absolutely a journey, and it just depends on the line of business. And the critical thing is the amount of data that we have underpinning that.
Finally, on this question, Ian.
Yeah, I mean, I think from our point, from where we are, I mean, we're, as I said, we're at the beginning of the journey. I can again I echo what's already been said about the external data, because I think that's where there's obviously greater scope for rapid collection of data. Because the issue we have is largely as a transactional underwriter, that it's quite difficult to get very rich and reliable data sets from brokers and from the original insurers. But and when you do get that, often there's a consistency issue looking at across different insurers. But the use of external, I mean, rating agencies or similar data sets, that does offer the opportunity to effectively harvest the data and to do some proper analytics on it. So I can see that to using these sorts of techniques. In terms of our own in-house data, we are hamstrung by what's available, and particularly on longer tail business, obviously you need quite a long time to build up those sources, and there's a cost and effectively in the market of the resistance to provision of that data, which makes it difficult to collect.
Can I ask then, I mean, Ian, based on what you just said there, I mean, how broadly do you think machine learning and advanced analytics can be applied? And for instance, are there types of business where this approach adds very little and perhaps more traditional approaches will always win out and be with us?
I think that I'd hesitate to say they never can, that they will never be useful. But I think at the moment, there's in certain segments of the market, there's an awful lot to be gained, still to be gained, in terms of competitive edge, in terms of understanding your risk profile through the traditional techniques, and even pre-GLM. So looking at one-way analysis, that's the stage certain sectors of the insurance market are still at. So I think we need to kind of walk before we can run a bit, and so there's a significant area of improvement that we can make at those early stages. I do think probably, certainly with the use of external data sources and through technology, there is and there will be more opportunities to consolidate broader data sets in a consistent and usable format, which then lend itself more to advanced techniques, and it will kind of you kind of need to use it to try to test so many different variables on using the more traditional approach. So I think in time there will be a migration. It's probably a one-way street, and we'll all move in the same direction, but we're not all going to move, particularly the transactional, where it's very much, there's always a layer of underwriter judgment on a risk. I mean, it's not like writing a motor portfolio where a lot of it, it's kind of commoditized. So you collect the risk factors and you know the price, but you're insuring a firm of solicitors or a bank or something, then there's only so much you understand through the rating factors, certainly at the moment. So it's horses for courses a little bit.
Yeah, thank you, Ian. Tim.
I wouldn't really have any more to add to that, Jonathan. I mean, I think the traditional approaches, as Ian said, one-way analysis, that those still are useful for some lines of business, And then there's just a spectrum from that sort of through GLMs up to machine learning. And I mean, typically what we've seen is in, say, personal lines insurance will adopt the more advanced approaches quicker first, and then they kind of gradually move into other lines of business, so SME and then up to large commercial. So I expect it to be that pattern. But yeah, to Ian's point, I'd expect all three approaches we described to coexist for some while.
Annarita.
I can only echo what's just been said. I think ultimately it's really all about how much effort do we need to put and what are the results we are going to get. And traditional techniques are very well embedded, not just in the skills that most of our people have in the organization, but also in our toolkit and systems. So in some cases, moving from traditional to new techniques would require some investment, so the effort could be quite big to actually deliver a benefit in the shorter term. But without a doubt, things are moving towards the direction of, machine learning and, advanced analytics. But it's a journey that will have really to just be around what is the effort, what are the results, what are the barriers, what can we do in the short term, what are our ambition in the longer term. So I think, we will see that shift moving and getting, bigger. But at the end of the day, really, it's all about, in some cases, I think we will talk about our pricing, current pricing tool more so as legacy as well. So we will have to look at it in that context and in the context of the results. So is the benefit of one technique against the other so much bigger to justify certain investments? But I'm a big passion and big passion about machine learning and advanced analytics. That's without a doubt where my heart perhaps is.
Garima.
Yeah, I mean, I think my co-panelists have really nailed it. It's not one against the other. It's, I think, a blend of both. Like everyone mentioned, for the personal lines, definitely with the advent of so much of data, machine learning, advanced analytics, there is no way we can escape that. We are already seeing it in the market. But for the commercial lines, we will still continue to use the old school. I mean, the case pricings are not going anywhere. The big deals, marine, aircrafts, I think they're not going to go anywhere. And maybe machine learning can help in ingesting data, bringing it together. But the way of measuring risk will still remain maybe GLM, etc. So it's not one against the other. It has to be a blend of both. Whatever gives a better results, use that and move ahead with it.
So can I ask Garima, I mean, how can different pricing techniques ensure fairer value and more transparency for customers? I think that's very topical at the moment with personal lines and the new FCA rules on general insurance pricing practices.
Oh, yes. I mean, actually, this is a very interesting question, Jonathan. The new FCA rule is applicable, as you said, on the personal lines of insurance. And what it basically prescribes is renewal premium should not be greater than the new business premium of similar risk. In layman terms, all FCA is saying is that looks like some of the insurers are increasing the premium when a case comes for renewal, knowing that the customer has higher probability of renewing with them, leading to a price walking. And so all we have to ensure is that transparency in premium calculations are completely maintained and the truly risk-based time renewal is done for new policies. So what I think, the way this can be really managed is by techniques of something called as good model orchestration layers. What a good model orchestration layer can do is really bring a whole synergy from data to model. Whatever happens is transparently reported back to the insurer and can be used for any reporting to FC or anyone else. I think when the new technology comes, along comes these other, supporting infrastructure, which helps you to meet them honestly. And it all depends, if we really want to follow the route of customer centricity to make best for our customers.
Annarita.
I don't think the core of the problem is around the pricing techniques or the techniques that are used. It's more around the framework that we adopt for each pricing activities. So it's about our ability to be transparent in which data we use, where we use it, how we use it, and the impact that each point of the data will be having in the price. Now, if we are able to articulate all of these points clearly and be transparent in this journey, in the data journey, into the pricing models, then we have achieved transparency. Then really the techniques that we use become generally irrelevant, provided we've been able to fulfill the governance and framework model. So I'm less worried about the techniques. I'm more worried about the ability to actually be transparent on all of these steps. And this is where I think most of the time at Zurich has been actually already. We've done actually already a journey about being able to absolutely be clear, transparent of each of these steps, and will be more in the future moving forward. We have absolutely a strong interest to be fair for our customers. We've always had it. And the data transparency and the data commitment from Zurich point of view is absolutely at the core of what we do. So to me, it's about framework more than techniques.
So at this point, I would like to come to our first poll question. We did ask at what stage your organisation pricing process is at. And the most popular answer, with just under 50%, 48.4%, was started using external data and machine learning techniques. The second most popular was using GLM models with 27.4%. And finally, the final one with just under 25% was using new age techniques and models is on our roadmap for the year next year. So the most popular answer there, started using external data and machine learning techniques. Ian, does that tally really with what you thought the response might be?
Yes, it does. It's not. I mean, it's not representative of our business, but we're probably at towards one end of the spectrum. So that's where I kind of assumed the market would broadly be yes.
Yeah. Tim, does that tally with perhaps where you might expect the general market to be?
Yeah, that does. That makes sense to me.
Yeah. Garima, I'll come to you, Finance.
No, absolutely. I think, as we said, these techniques and everything is coming new. The early front runners have adopted it. Others are also in process, but, it doesn't surprise me. I mean, it looks pretty okay.
Okay. Perhaps we can move on now, and I'll come to you first of all on this, Tim. Insurance is often painted as a siloed business. And with this in mind, how do you enable information sharing and workflow mechanisms between, say, pricing and underwriting?
Yeah, so at QB, we really think of pricing as part of the underwriting process. And so an example of that is I, for example, report to our group chief underwriting officer. So we try and think of them as, just part of the same process rather than, two separate functions. And I suppose to give some practical examples of how we make that work, when we're developing a new pricing model, that will be a joint project with pricing and underwriting. So, key stakeholders from both pricing, the underwriting teams. And then when we're thinking about how do we deliver that model, how do we deliver that algorithm for the underwriters to use, as you touched on in your question, we'll think about the workflow a lot. How can we integrate that into the existing workflow to make it as seamless as possible, as easy as possible for our underwriters to use? And then the final sort of point would be, in terms of feedback loop, then when we think of management information, the information we provide to the underwriters, some of the key points within that will be from the pricing models. So things like rate change, rate adequacy, that's something that comes from the pricing tools, will then be kind of embedded within the MI that the underwriters use for their business. So, effectively, although there's slightly different skill sets, we think of pricing as part of the underwriting process, and to operate that way.
Garima.
Yep. I would say, the corporate silos is not just restricted to insurance, but it's true for any big corporate. where different departments work in watertight compartments. Finance doesn't talk to sales, marketing, pricing, human resource, underwriting, claims operations. But, etc. I mean, all of them, I think somewhere or the other, we have seen in past that not allowing data sharing seamlessly, and hence sometimes the key company goals are missed. And this is why a single source of truth, what we call, a data, maybe that can become a single source of truth, is very important. It helps in, creating common goals for all the departments and bringing in synergies, especially in insurance. I believe that having joint goals between pricing and underwriting teams really help. When performance monitoring dashboards are common between actuarial and, underwriters and the pricing teams, specifically to their business line, and they really work together to meet those goals, it brings out the synergies and the silos are overtaken. I see today a lot of pricing and underwriting teams are working together. Models are built by pricing teams, but it's the underwriters who use them. So the success of one is determined by the other, and hence, again, a teamwork. I also see that pricing teams are regularly involving underwriters in the model build stage itself. Instead of, just building something in the background and giving it to underwriters to say, go use it, they actually get underwriters involved and ask them to share their field experience. What are the challenges they have seen before? What are the actual problems they have seen while using previous models? And then molding their models accordingly. And this is how, the silos can be overtaken by everyone.
Annarita.
I don't think I've got really much to add, actually. At Zurich, we have a similar structure whereby pricing and underwriting both sits under the chief underwriting officer. The different part is that my team, which looks after the science and the claim cost modeling, sits in operations. But we have established a really, really strong framework in terms of collaborations, and now we set up processes and projects, which means that we all then sit at the table when it comes to developing pricing models, which really gives us, as was said before, that view both from a pricing perspective, from an actuarial perspective, from an underwriting perspective, and from a data science perspective. I think one of the things always to bear in mind is that often some of the barriers in the silo are really about systems. It might sound that I'm always saying the same thing, but that's what it is. So some systems are accessible by certain areas, some are not. So an overview of how to make sure that systems become accessible to everyone, that's definitely something that has helped us at Zurich. And also there is also a part around education. So I think depending clearly on the people you have on board, but it's been a bit of a journey for us too to really bring everybody on board from a data confidence point of view. So how do we all support and understand what the data trends are, and feel confident about making decisions as a one. About pricing or even like underwriting rules on the back of the information that we have. So yeah, definitely something around system, but also around education and data literacy that has been really good in the collaboration we've had within pricing, underwriters, data scientists, and analysts.
Finally on this question, Ian.
I suppose I don't really see the silo. I've never really experienced the silo issue itself as a problem. I think maybe it's in the commercial organisations, the commercial insurers or London market insurers, actuaries where they are involved with underwriting tend to work quite closely with the underwriting teams, and so that there's not those barriers to break down. I mean, we work. As the other panelists have said, I mean, it's very much a case of when we're building a pricing model, we don't go and take the data and then present a model. We work very closely with the underwriters, and because they will always have, particularly with our type of business, they will always have insights that go over and above the data, what the data can tell us at this stage. So So there's always valuable input anyway. And in the end, there's always an element of judgment on the transactional risk pricing that they can apply. So it's very, very important, obviously, that they understand the models that are giving them the base price. I'd echo very much what Garima said about dashboards, and if you get the output from the pricing model, which feeds your data, feeds your underwriting system, and the results are then apparent to the underwriters on the dashboard, it just helps to keep their buy-in to the pricing models, and actually it creates a virtuous feedback circle that in the end, where things aren't what they expect, well, then they can challenge, and as the modelers, the actuaries, they'd have to answer to those challenges, and that serves to either improve the underwriter's understanding of what the model's doing, or improve the quality of the model if it's missing something. So it is very much of a collaborative process, I think, already. The silo issue itself, certainly in our sector of the market, I don't think is a big problem.
Thank you very much, Ian. I'd just like to remind the viewers that we do have another poll question coming up, and that is, what is the biggest challenge you face today in pricing? And there are 3 responses: data protection, availability of good pricing models, and losses due to wrong pricing. So if you can get your thinking caps on, answer that question. And also, if you have any questions to the panel, put it in the tab, use a tab and ask the panel, and we will come to these later. Perhaps building on this theme, I'll come to you first of all, Annarita. I mean, are there any then silos outside of pricing underwriting, say claims, that also need to be integrated so an insurer can make the best pricing decisions possible?
I think we have learned in the last few years that the power of information sharing is huge, both from the impact we could have to our customers, but also to make really our operations better. So I mean, at Zurich, we've always had a really strong collaborative environment, but perhaps in the past, the silo was mainly caused by data systems, I would say. So the fact that, for example, claims might have had their own data system compared to underwriting and pricing had. So with underwriting and pricing looking at policy side and exposure side, and claims looking specifically at the operations claims side. So in more recent year, we've gone through like a really strong data transformation, which, as you can imagine, has actually brought together all this information in one, and the power has been great. I think what I always love about the fact that in insurance, we've got so many really good technical skills in different areas, and we can all look at the data from a different angle and being able actually to challenge ourselves. So the way claims might look at data from a more of reporting or incident data or operational way, while underwriting will look more on a side of underwriting years, and then pricing can look at what the impact of the new pricing would have on our profitability. So those conversations have always been good. I would say at Zurich, I haven't really seen a lot of silos. When that happened in the past was mainly just because we could not bring this information together. Now that we can, the conversation and the conversation we are having, the benefit that we are getting is definitely valuable. I would like to see other areas to come on board, perhaps more operational area complaints, perhaps, so this, but again, it's part of the journey, but we are definitely getting there.
Ian, do you think it's valuable to bring other parts of the organisation along this journey, perhaps outside of the underwriting and pricing?
The only one I'd say is, the most important one is probably claims for us. But again, we're maybe different from some of the other organisations because we operate as relatively small business. Dual as a business operates in multiple territories, but kind of feels a bit like a small company. So the underwriting, finance, operations, claims, actuarial, it's quite a small team, so there's not really the issue of silo. I mean, there is always the bigger problem is always data, because systems have never, when they were originally set up, they were never set up thinking in the right, and that we might want them to talk to each other, and we might want different people to use data for different purposes. And And for our business, which is longer tailed, then once you fix that, you've got 5 years to wait before it can be really useful. So that's a big inhibitor really to what we're able to do. Obviously, by taking advantage of the insights that the individuals in the claims department have, we may be able to overlay some interpretation on the data that's not perfect, but we can use it. And so those sorts of collaborations, they're very important to try to make use of imperfect information. But again, I don't think from a point of view of our business, silos themselves are not an issue. It's simply the legacy of things that have been done in the past that don't necessarily lend themselves to the perfect route to go forwards from.
Tim, would you concur with what's been said?
Yeah, I would. So I'd echo Annarita and Ian's comments around data. So certainly one thing we're working on is joining together different data sources so that everyone is using the same data set. And then I suppose the other thing it's worth mentioning is that at QB, we wanted to make sure that these different teams were consciously having conversations. And so to underwriting, pricing and claims that you mentioned, we also think about the reserving and capital modelling teams. And we've set up a framework of pricing committees with representatives from each of those teams. So underwriting, pricing, claims, reserving, and capital modelling. And those committees meet monthly just to talk about what's going on. So the claims team will see, here's new types of claims that are emerging. Those we need to think about incorporating into our pricing. Reserving have a longer term perspective, and so that's part of the feedback loop. And then the capital modelling team, they'll have a view on how much capital are we needing to hold to support different lines of business. And so, completely agree with the point about, joining the data. And then we've overlaid this framework of pricing committees just to make sure those conversations are happening as well.
And finally on this question, Garima.
Yep, I would say, structurally and historically, silos did exist. But with the coming of the role of chief data officer, these committees, like Tim mentioned, because of the need of every department to work with the other, these silos are kind of disappearing now. For example, you mentioned about claims. Claims data is used both while building pricing models and while underwriting through claims experience factor. And I feel every department is interlinked with pricing already. The underwriting experience parameter to be used in pricing is based on overall experience of an organization. And the profit margin inputs would come from finance function based on their return on capital employed targets. So I see in many pricing and actuarial teams who are building these kind of analytics data hubs, pricing data repository or data repositories, which combines the data from claims, underwriting, finance, and other departments. And hence, the silos are disappearing because the goals of the teams are put together to deliver overall organizational goals. Hey, Jonathan, we can't hear you.
No.
Sorry, I did a cough and I got to put the thing back on. So, Garima, can I just ask then, we've heard it's been mentioned a few times about using external data sources. How can insurers use both internal and external data to make more accurate pricing decisions? And what challenges exist in integrating these external data sources?
Oh, yes. I would say this is the question which is, which catches everybody's attention when we talk to. I have generally not seen gold standard data available with any company. Even their own legacy data is not in a shape and form that it can be readily used. And also with the coming of new risks, like say cyber or terrorism, there is no or very less internal or experienced data available. Hence, external data is the only way, you can really price this risk, and it becomes very important. External data is useful to create better and dynamic models and get market and competitor insights also for making strategic decisions. Many providers today, there are many data providers who are providing different forms of data. Insurtechs who have come up and who have come up with very fancy offerings to help bridge the data gap which insurance companies face. However, like you mentioned, the challenge in using external data is threefold. accuracy and reliability of the data, cost, and third but not the least, effort involved in handling data preparation, because this data may not be completely aligned to your internal data to make full sense of it. So I would say it will be great if some external industry associations, which are non-profit institutions, can also facilitate data sharing between the insurers, and then in turn they can also publish some benchmarks which can be used by insurers. But yeah, external data is heavily available, and it's the way to bridge the gap which all of us face in our internal database.
Tim.
Yep. So I suppose firstly, completely agree with the premise of this question. So yeah, we do need to make the most of both our internal data and external data. And the couple of things I'd highlight would be, for internal data, what we think about a lot is the unstructured internal data. So things like claims descriptions. The good news is now that there are techniques or technology exists that lets us mine those word descriptions for useful information for pricing, and so that's referred to as natural language processing or text analytics. And so there are techniques that let us make more from our internal data, kind of unstructured data, that in the past we weren't able to use as well. And then on external data, absolutely agree with Garima that as risks change, that the external data becomes more useful. And I suppose the challenges I see in relation to that, one would be just the provenance or the kind of quality of that data. With our internal data, we know where it's come from, we know how reliable it is, whereas with external data, you have to take it a bit more on trust. And so that's something we think about. The second sort of practical challenge would be just how we connect it to our systems, map it to our data. Often we'll just use different codes, and so there's a mapping exercise. And then the final thing we think about is that, as Garima touched on, that there are kind of new companies emerging all the time with different external data sources. So it's kind of keeping track of what sources are out there. And we've found that we need to have quite a sort of nimble operating model so that we can switch from one data source to another as they evolve, as one becomes more powerful. So but both the internal and external data, much more that we can do with them, and there are a number of challenges in terms of using external data.
Ian.
I'd echo what's already being said. I think for us, we're at the early stages really of trying to use external data. So whilst we are using it, it's in I guess a transactional way. We don't have an integrated system to do it. It's more as underwriters will, in certain areas where underwriters are pricing risk, they will look at make use of Dun and Bradstreet screen or something of that sort. And I think what the next stage of that is obviously to try and mimic what they're doing to automate that process, so there's no overhead, less overhead in terms of their time to bring that in, and then start integrating that into the pricing, the parameterization of the pricing model. So we're a little way away from that. The issue, I suppose, in part is as others have said, that the external data, you have to take it a little bit, particularly when you're looking at corporates, it's not always immediate which part of the corporation that they're referring to, and it may be a different part to the one that we're insuring, because we wouldn't necessarily be insuring the whole thing. So there are practical issues in terms of using that, but obviously there's a lot of value in it. The internal data, it's what I said before, though, it's really, we need data over a long period of time, and the history isn't always reliable or isn't always collected in a consistent way. So we are going through processes of trying to cleanse and get what we can from that historical data, but obviously that brings its own uncertainties. So there are plenty of challenges, but it's still, in many cases, there are still gains to be had by going through those processes, I think.
And Annarita.
At Zurich, in the last few years, we've made quite a substantial investment, both in our internal data, but also in our external data landscape. which means that we have now been able to create an internal data environment in the cloud, allows us to really being able to access information when we need it, and with the right level of controls. And I'm also quite proud of the work that we have done on the external data side, both working closely with some trusted partners that we purchase data from, but also by building our own internal external data hub, as we call, which is, I would say, a combination of infrastructure, processes, and data science to transform mainly open source external data into usable, auditable, and repeatable data sources that we could then use and plug into our pricing processes and other things that we do. And everybody actually has already said that the core elements of external data is about the ability of using the right key to link it to your own internal data. We've also spent, a huge amount of time and resources actually in building some of the keys that then allow us then to plug this information into the pricing models or into some of the systems when we need it. External data is also part of our analytics strategy and our ambition, to 2025 to get to a point where we are really embedding external data in most of our processes. So without a doubt, an area that I'm very passionate about, and I think there is a huge potential in insurance to really offer a good value for our, for our customers by using, external data and internal data, the combination.
Yeah. Can I ask Annarita, I mean, technologies, there are lots of technologies out there. What types of technologies linked with data and pricing do you think provide the best tools for insurers to remain competitive and maximize profits?
So we have also gone for a journey about technology actually very recently. So I think we have all learned in the last probably few years that the technology that stays are the one that can be flexible enough to be changed and also to be flexible based on the need you have. So without a doubt, the cloud has been really for us has been a massive success in terms of giving us the ability to churn a lot of data, a huge amount of data much more quickly and efficiently, to give us the right audit around how data is utilized, and also the flexibility, because with the cloud and with any tool in the cloud, you can flex it and make it bigger when you need it, and then you don't have to pay all the time. So and at this point, I would say that's definitely the place where we have seen the biggest success, because it's really, and I'm sure my colleagues on the panel will agree with me, one of the biggest part in any time we refresh pricing is really around our ability to manipulate data. So the more efficiently we could do that, the more efficiently we could price in the market, the better we are then at offering fairer pricing, more accurate pricing, and as in general, better customer value.
Ian.
Yeah, I mean, I echo that. As for the types of technologies, I mean, I suppose I'm kind of relatively agnostic as to exactly what it is, but the important things are that you have the flexibility, that you have the ability to bring together data from, I mean, in an ideal world, from all of your legacy systems into one place where each field means the same. It's all obvious stuff, but where the label on the field means the same thing wherever it's come from. And so you need the flexibility. You need something that's going to be able to be adaptive going forward, because it's great. We can go to the most state-of-the-art system now, but we don't want to have to go to the state-of-the-art system in 5 years' time either, because that involves working with the data. You want something that's going to move with the times, and so has a decent lifetime ahead of it. And you want it to be something that's very easy to use, because the harder the data used, the less it will get used. To slice it, then obviously the more you're going to do with it, and the better quality pricing models you're going to develop, and the more accurate pricing, and the better value for customers, and the better profit. So it all goes together. But the key is just a system that gives you some consistency, some flexibility, and some longevity, I think.
Garima.
I consider myself very technology agnostic. So whether we use, the open source tools or we use the proprietary tools, I think it's the results which matter, which is basically to help a pricing group make better models, predict better risk, and reduce the loss ratios. However, I cannot overlook, how the world has changed. We all talked about how the data is increasing, it's big data. And with the coming of big tech players like, Amazon's, Google, Apple, Tesla, Ford, in this insurance market, I feel technology is invariably very important. Customers today are very, very ready and are asking for individualized risk pricing. Nobody wants to pay more. They want to pay less, and they want to pay for what they are using. And in such a scenario, all the key new technology stacks which have come in, whether it's NLP, NLG, natural language processing or generation for converting unstructured data to structured, or computer vision to assess loss at a click of a button, blockchain for syndicate pricing deals, or cloud, like Annarita mentioned, for having accessibility anywhere around, or for, artificial intelligence and machine learning. We have talked already about it a lot, but I think that's the best way to make models today. Or IoT, smart cars are here to stay. And, with all these technology coming into picture, I think we have a lot to gain from all of them. You may have heard about, recently Ford, along with Buy Miles, announced that they will be creating a pay-as-you-drive proposition for insurance. And, these kind of big tech solutions will just sway away our insurance industry. Hence, we have to adopt the new technology, become very agile, and, adapt to it to really offer the best to our customers.
Finally, on this question, Tim.
Yeah, so I'd use the same word, agnostic, also to capture my view. So, yeah, I'm agnostic as to which particular technology we use, but we do spend a lot of time working with our technology team to make sure that we can kind of leverage different technologies. And we think about the systems architecture, so a kind of component-based architecture, or people talk about APIs, application programmable interfaces, so that we can have just different components of talking to one another, and then we can sort of swap out one component when we want to replace it with another. So although we're kind of agnostic about which particular technology we use, we're trying to design an architecture so that we can swap in and swap out components as things evolve.
Just like to come to the final poll question. We did ask you what is the biggest challenge you face today in pricing, and by far and away the biggest answer was data preparation, with 71.1%. Just under that was 20% said availability of good pricing models, and only 8.9% said losses due to wrong prices. So data preparation was by far and away the best and the leading question there. My final question, we've only really got a few minutes, so I'd appreciate if everyone was quite short and snappy with their answers there here. And Garima's covered probably quite a bit of this, but in conclusion, and to quote the top of this broadcast, where does the future of pricing go next in terms of using technology to provide insurers with actionable insights? And I'll start with you, Annarita.
I think, in a nutshell, I think it's all about being fair, being transparent, and drive value both for the customer and for us as an organization. Anything that could do that hit these boxes will be welcomed. And rather than suggesting something, I would say look at the purpose, and that is without a doubt, from my point of view, the purpose of in the pricing space.
Tim.
Yeah, it's using technology to, I suppose, improve pricing for the customer, and two particular examples. So firstly, I think we'll see the process of pricing becoming simpler and simpler. So the kind of automated quote and bind that we see in personal lines, that moving to commercial lines. And then the second thing, recommending actions. And so saying to the customer, did you know that if you take this action, then we'll be able to reduce the premium? So more and more of that kind of, I suppose, bespoke advice happening in commercial lines as well.
Ian?
I think certainly from our perspective, I take my lead from the poll results. I think the key is data. We need to get, we as an organisation need to get better at collecting, controlling and managing data, and with that forward in terms of pricing. We're not, certainly our sector of the market, I don't think it's constrained by pricing techniques. We're really constrained by data, and what we need is more reliable, more of it, good data.
And finally, Garima.
Yep, I mean, I know it's the closing one, but Jonathan, my answer to this would be, today business is technology, and technology has become business. It's the era of artificial intelligence and hyper acceleration. So artificial intelligence is definitely going to help us to automate and actually make the life of our underwriters and pricing teams much simpler and better. Till some years back, we used to see about big customer service teams, but today they have all been replaced by chatbots, or at least to a great extent have been replaced by chatbots. Very similarly, I think using artificial intelligence, we will be able to create a world where underwriting and pricing can be done through an automated fashion to a great extent, at least for the older risk. I'm not talking about case pricing, big deals here. And this will give, quality time for our underwriters and pricing experts to focus on the big decisions. Instead of, doing every deal by themselves, a lot of automation, a lot of underwriting is going to get automated. And I think that's the way industry is going to move. Anyone who's riding the wave will definitely win it. And, maybe very soon, I think the companies who have these kind of technology will be ahead of the curve.
Well, I'd like to say a big thank you to my panel of Garima, Ian, Tim, and Annarita. Thank you very much for your time. I'd also like to say a big thank you for everybody out there who watched it and took part in the poll question, asked questions. And finally, a big thank you to our sponsor for this webinar, WNS. What's left for me to say is I hope you have a good evening, and you can join us for our next webinar. But until then, it's goodbye from me. Cheerio, everybody.